Hello, and welcome back to the Fintech Takes podcast. Today's episode is special. I've long been intrigued by the long-form podcast format in which hosts and guests go deep into a bunch of different topics over the course of several hours. Some of my favorite non-fintech podcasts in areas like business, AI, and writing have adopted versions of this long-form format to great effect. However, I haven't seen many examples of this format in financial services, and this has always struck me as a bit of a missed opportunity. So, as we head into 2026, I've decided that Fintech Takes is going to take a whack at it. Now, of course, the challenge is that there aren't that many people working in any industry who you'd want to listen to for more than 30 to 40 minutes. And that's not a knock, by the way. It's just the reality. Very few people in the world are insightful enough and experienced enough to be a good fit for this long-form format. However, there are some of those folks out there, some of them working in financial services. And the neat thing about having created Fintech Takes for the past 6 years is that I now, hopefully, have the ability to reach those folks and convince them to come on the podcast. So, today is the first episode in this new recurring format, which I'll be calling our Diving Deep episodes. And I could not be more thrilled about our first guest, Max Levchin. Max, as you probably know, is a co-founder and former CTO of PayPal, and a co-founder and the current CEO of Affirm, which makes him one of the most influential people in the modern history of fintech. In our conversation, we talk about that history, how to avoid the problem of chasing the right idea at the wrong time, his views on Affirm as a two-sided network, better living through mathematics, the future of credit cards and BNPL, and of course, AI and agentic commerce. Now, I doubt I need to sell you any more on this episode, so without further ado, here is the first episode in our newest format, Diving Deep with Max Levchin. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. All right, Max, thanks so much for joining me.
Thank you for having me.
It is absolutely my pleasure. This is going to be fun. We have a little bit more time, so I thought we'd kind of wander around a few different topics. And where I wanted to start, actually, is a little bit of history. I have been doing my homework and doing some research on the early history of Confinity / PayPal, and reading about all the very early days, which I'm sure takes you way back now. And one of the things that was, I think, maybe one of my kind of favorite anecdotes or things that I read was the early kind of search for product market fit. And one of the things that I guess I did not really realize, because I became familiar with PayPal as a customer much, much later, obviously, was that a lot of the early ideas that you guys were kicking around, mobile device encryption, mobile wallets, contactless P2P payments, they were really innovative. And I was struck by the fact that like pretty much everything that was described that you guys were looking at the time fit exactly with where like the market was going, where technology was going. A lot of it is stuff that's like either happened or is very much like in the zeitgeist right now. But of course, all of those ideas were too early. And, you know, by contrast, the first kind of killer feature for PayPal, the sort of ability to email someone money using an email address, seemed from what I read to kind of be a bit of an afterthought initially in terms of the features. And I was curious because I have this conversation a lot with founders about like, you know, an idea too early is, you know, it can be the right idea, but if it's too early, it's wrong. I'm curious kind of what you've learned about this tension between, I guess, innovation and good timing when it comes to building companies and building products.
I think that's actually a fairly common thing in the world of startups and innovations. And I think it's maybe more than anything a difference between being a futurist and a product designer. And a lot of us product designers think that seeing the future is hard and that's our job. And that's certainly what I was doing in the PayPal days. And yeah, it's actually the opposite. you can pretty readily see the future just by reading enough science fiction books. Like if you crack open anything from turn of the 20th century, like Jules Verne, you'll promptly see like, oh, well, he thought of submarines and all these, amazing technologies that we now take totally for granted.
Yeah.
And I think that's, that trains us as we grow up to be product designers to think all I need to do is look into my mind's eye and the time domain doesn't matter. Like, if Jules Verne could see the submarines because they were just being talked about then, and poof, we now have nuclear power submarines. What I need to do is see what the future looks like. And, we saw Palm Pilots. I saw the first Palm Pilot was the first real handheld device that would fit into your pocket versus all the things that came before it. And Newton was supposed to be a handheld device, but it was more of a brick, not a thing that would fit into your pocket. And so as I saw that, I was like, oh, goodness, that's a computer that fits into the palm of your hand. So, what's the future going to look like? It's going to need to have real security because it's going to have my most sacred and secret documents and my money and my contracts and all these things. So like, what we need is to go build encryption libraries that work on really low power devices. That was the impetus behind the original Confinity. And like, that's totally true. It all came to be.
Yeah.
But if you are a thoughtful product designer, your answer is actually there are zero contracts and zero anything of value that sits on this fewer than 1 million devices sold mostly to nerds like me who just want to play with how to write code on this thing or for this thing. And so the sort of the comeuppance that I got back then was, it was very clear in the moment that we were too early. And the conversations internally were a little bit more like, all right, so some of these ideas are great, but they're clearly 5, 15 years out of time. How do we make sense with what we have today? And the honest answer then and now is it has nothing to do with handheld devices and nothing to do with Palm Pilots. It has everything to do with the fact that there's absolutely no way to move money online. And we invented an extremely elaborate way to move money using 2 Palm Pilots. And that's cool, but you just needed to move money. And, the product market fit there came by like hitting us in the face and saying your web demo is more useful than your product because the web doesn't have this functionality at all. And so it's a long-winded way of answering it, but I'm often on the record with this notion of hard, valuable, and fun. And it stems from right around the same time, actually, Peter and I had this conversation that I sort of still remember vividly where he said something along the lines of the thing you built is really hard, but I'm just not so sure it's valuable. And most things that are really valuable are hard, but not everything that's hard is really valuable. And so you should always understand which way the arrow of causality is pointing, because then you can decide whether it's something that you really want to spend your next 10, 15 years, or in my case, back then, 4 years working on. And so as we saw the market pull, my real lesson back then was, hey, from now on, when I'm gonna invent things, I'm gonna try to make sure I have a problem in mind versus a puzzle. Solving puzzles is great, and I love solving puzzles as always. But real problems are more important.
It's that's an interesting point too, because I think the other thing, and you referenced it, like back then, Palm Pilots were the domain of people who really thought that it was cool to have a computer in your pocket, right? And there weren't that many of them. And to the extent that like those people had it, it wouldn't grow that much beyond there, right? And I've talked about this before as like, in fintech, I see it a lot as like the 15% problem, right? Where I'll see founders build something and they build it for them. They build it for them and their friends. And, it always gets to like, if it's maximally successful, like 10 to 15% of the market who has kind of a brain or a set of circumstances that sort of work in that way. And then it just hits this wall. And the thing that I've noticed that's really challenging, I think, about it is that first 10 to 15% of adoption, it's not just customer adoption, it's like rabid customer adoption, right? And you see this like today with even things like note-taking apps, right? There's always some new person inventing a note-taking app. And for people whose brains are just craving like a new way to do note-taking on a mobile device, like they just glom onto it and they run to it immediately. But then it just slams into this wall and it doesn't go any further. And I guess I'm curious on the problem side, when you're trying to tack towards valuable and you're thinking about what problems to focus on, how do you like make sure that the problem you're focused on is one that is like relevant to a large portion of the market and isn't just, oh, this is a thing I see because it's me or it's my friends or it's my family?
Yeah, it's funny. I have exactly the same outlook on this problem. I don't call it the 15% problem, but I think it is uniquely afflicting off the fintech universe. So I call it the mint problem, which
that's where I came up with this was personal financial management.
Yeah, so every 3 years, someone says, you know what I need is to connect all my accounts and get a perfect dashboard of my finances and really know what my cash flow looks like. And I want to color code it, and with AI and in 3D and the people who are like, oh my God, where have you been my entire life? I gotta have this thing. Of course, I'll subscribe for this thing for $30 a month or a year or whatever the cost. Those are the same exact people who had that exact reaction to the last one of these and the one before and the one before and the one before, going all the way back to Mint, which was the first one of these, like connect your bank account, difficult as it is, Yodlee's half broken, doesn't matter. It's so much easier than doing this in Excel. And of course, that very same group, probably like their parents or the genetic precedents of these people, were like, all I want is to balance my checkbook. I got this piece of paper and I'm never going to miss a dollar or a penny. And that group of people is like, maybe, I think 15 is very generous. I think it's like 3% of the population.
Yeah.
And so that group is your total target market. And for some of them, $30 a month is too much and they're not going to subscribe, but most of them are very good with money. So they actually have the money to burn on having a better tool, but you're sharpening an already very, very sharp pencil. You're not expanding your bag of pencils and pens. You're just saying for this particular consumer, like the prosumer of personal finance, I got you your next Mint. Let's go. And there's a handful of these apps right now, and they're absolutely stunning. And they're just like that much better. And yet, like, I know what their growth curve looks like. It tops out. Anyway, so that we agree on that front. The thing that I try to do, and again, back to sort of, over the years, I spent a fair amount of my time rewiring my brain from being that of a software engineer to being that of a software designer. And software engineers, which I still am one as much as, try as I might, love a puzzle and build for themselves. And great software designers or product managers, product designers, the first thing they do is they say, let's embody the mind of a normal. Someone who lives in middle America who is not, in fact, a well-educated, computer science aware, design conscious, someone who's deeply obsessed with balancing their checkbook. In fact, like the canonical person I loved to imagine when we were designing a firm was a mother with a baby in her arm, pushing a cart in a multi-lane checkout environment, trying to pay for something. You have one hand, you got a line behind you, you got a screaming baby, and a cashier who's overworked and underpaid. And the cashier is asking you, hey, are these organic or not organic bananas? I can't tell from the label. Like, that's what that experience feels like. And you have to deeply feel that to design a product that doesn't suck. And so the idea of like, oh, cool, I'm just going to go into my app and dial me up a digital payment option is like, sure, or I'll go for the thing I know how to use, which is what's top of my wallet. And so I think just having that mindset and reminding yourself you're not building for yourself. If you are, you're going to run into that 1% problem again and again and again. And so that's where that's, and over time you become better and better. I remember giving a talk at like startup school or something years ago where I said something along the lines of, you have to embody the mind of a 17-year-old girl when you are trying to build a social media product. And the room looked at me like,
sure.
Like, what exactly are you talking about? And why does this sound vaguely sus? Like, I don't think you think what I think it means. You need to be so one with your customer that you understand what motivates them. And like the baby on your arm is a real problem. I used to go to Whole Foods and watch people check out specifically to understand how this actually works. And it works pretty simply. You put down the wallet, you pull it out with one hand, and that's the card that you're going to use. And so plastic is not going away anytime soon because of that specific modality.
Sure, absolutely. Well, so I was going to ask, like, so you would actually go to Whole Foods and
Yep.
just watch, or like, I mean, like, in terms of, because I think this is the other thing that I sort of sometimes I analogize it in my head to like screenwriting, which is a strange analogy, but like it's kind of like if you're writing about like working in a hospital, like old school screenwriters, they didn't like have Google. They would actually like go to a hospital and embed themselves there for like 3 months and like hear the language and see the rhythm of how it was working. And so, I mean, in terms of like putting yourself in the mind of your customer, is that kind of, do you guys still do
Oh,
that at a firm? Is that like a thing that's very central to how you approach
very much
product
so.
development?
I mean, part of why I do my own customer support on Twitter, we met
Right.
through me trying to offer customer support.
Yeah, how we met. Yeah.
It's not just because I care about the product, although I certainly do. I want to have that first touch moment when someone is upset or confused or unhappy. You can read your own copy 1,000 times. Like the number of times I'd written what I thought was a great piece of product copy, use this in the following way, and then show it to someone. They're like, what exactly do you mean by this word? I'm like, does the word synchrophasotron mean nothing to you, you idiot? Like, no, it turns out to be not a commonly used word when it comes to day-to-day consumer physics. And so that I absolutely do. One of my favorite things to do when I travel, and in fact, every city I've ever been to more than once, I can name my favorite grocery store to go to people watch, primarily to figure out how they shop, what they buy.
Yeah.
Like you learn a lot. Like I haven't been to Shanghai in forever, but there is a Japanese themed grocery store underground right next to my favorite hotel in Shanghai. And I would go there like right after getting off the plane because I wanted to see if they changed the way they place things on shelves, what's eye level, what's below eye level.
Interesting.
Like they added self-checkout way before anybody else did. And it's like, I'm dying to understand how this self-checkout thing works. And like they had a person help you self-checkout because it turns out to actually be harder to self-checkout than not. So anyway.
Certainly been my experience. No, that's really, really fascinating. And again, like there's just no substitute for it, right? I mean, that's the thing that's challenging is there's just no other really good way to do it. I want to go back to the software engineering point that you were making before, because like you're an engineer in your heart of hearts. And one of the best quotes I think I've ever heard actually was something that you said on a firm's Q4 earnings call this year. And I'm just going to read the quote because I love this quote. It's quote, "We love math here more than just about anything else. I think most of our competitors just don't, and that's our strength. Our advantage is that we live better through mathematics," end quote. First of all, I think you have to have an Affirm shirt that says "Live better through mathematics," and if you have those made, I would like to get one of those.
That's a good idea. I'll take a note to do it.
Necessary. I love this quote. My mom was a math teacher for 35 years, high school math teacher. So like I need to get her a t-shirt. But I did want to dig into that because I think it does speak to that sort of like engineering, like we just love math. We want to live better through mathematics. And I wanted to ask you a little bit about kind of the evolution of credit underwriting, because I've made a bit of a study of this over the years, having worked at FICO and worked in the space for a long time. And one of the things that I've noticed, and I guess it's not that different from disruption in any field, is that it kind of moves cyclically, right? And so everyone sort of standardizes on one way of doing it. And then someone comes along, has a different set of incentives, and comes up with a different way of doing it. In the mid 90s, this was Capital One, right? With risk-based pricing and propensity models, and like really being able to figure out like, how can we engineer the outcomes we're looking for using math in a way that others aren't, right? And they pioneered, things that we're all now doing in credit risk underwriting. But in 1994, it was really revolutionary. I wanted to ask you about like real-time transactional underwriting, because when I think about like point of sale lending has been around forever. It's not a new idea, but it seems like what changed was it 2012 when you guys got started?
We really kicked it off in 11, and 12, I think, is like the official 11 incorporation date. Affirm came out of speaking of hard valuable fund. So I had sort of a brief historical detour, but Affirm was birthed in kind of a very slow 9-month process or so, where I was hanging around with a couple of friends who eventually became my co-founders, but who I mostly knew from PayPal years. And we talked a lot about underwriting and how we build these super elaborate models. Like when we were at PayPal, random forests were already a thing as a modeling technique. But we absolutely pioneered it. No one in the industry that at least I was aware of was doing random forests to do fraud fighting. And we built these ensemble models that attacked each other and, you know, voted on outcomes and did all the sort of oversampling techniques. And a lot of these things were just coming out of our own research. We were not, I mean, we're reading all the academic papers. Obviously, Berkeley is where a lot of this stuff came out. And yet we were like definitely being told by a lot of people, like, what are you doing? Like, there's some very basic ways of doing this. And at the time, my answer was, but like, if you imagine this thing as a curve of events, like you are like literally living in these like lumpy sums, like you're barely approximating the curve. Like you don't understand integration. And like these things are infinitely differentiable. Like you should only be using integration. You should not be trying to like build up a bunch of, you know, rectangular blocks to sort of use. Your mom would appreciate this analogy maybe more than most.
She would. I'm thinking of her right now.
And so we're like, I just like people who compete with us, like they are stuck in middle school math, and we're like, we can't wait to get to grad school. And so like that was always, and it's a little bit of a hubris. Like obviously at the time we probably thought we were the smartest tools in the shed, and we certainly weren't. But we definitely were a lot smarter than some of the players that we had to compete with. And so the same cast of characters, but like 15 years older and a little bit more grounded and slightly less self-obsessed. So like, you know, on the one hand, like we learned a bunch of things. There were a lot of other smart people doing a lot of other smart things. Maybe we didn't really know about them, but this notion of a lot of competitors, a lot of people who have to solve these problems, just choose the easy way out. They take a score that someone built not for the purpose. Like FICO is a brilliant company and an amazing collection of people and research, but the tools are primarily written that FICO creates. They were all published for the world that was largely offline. And so the decision to say yes or no was around the person, their ability and willingness to repay at the time of underwriting a line of credit or a mortgage or an insurance policy or something that, you know, it's a moment in time.
Some big thing. That
and so even though the event chain or the event curve is infinitely differentiable, they just didn't have the luxury of saying, and by the way, we reserve the right to change our mind next time you swipe your card, because that just wasn't a thing. You could do it to fight fraud a little bit, but like, no, you can't change the risk assessment, and certainly couldn't reprice it. And so you have to reprice it on the spot once for every 5 years on average or whatever. And so we had all these conversations, and basically like, if we applied the same kind of, if you're willing to do calculus or slightly more complicated math, surely we're going to find some real savings. Like the area under the curve, we're going to fit with our approximations. It's just going to be much smoother. We're not going to have these big lumpy boxes that are adding up to something roughly resembling the area under the curve. And so that was the foundational kind of logic behind Affirm, where we can do better through math. And the better living through mathematics is like, I mean, obviously it's a reference to better living through chemistry or whatever the exact line of that album. But it's in our DNA, this idea that you can and should not be afraid of applying progressively more sophisticated math to these problems if you have the opportunity to benefit from it. And we thought that point of sale lending in particular, which by the way was a later idea, we really settled on point of sale lending because it's the sort of a self-distributing loan type. Like we weren't particularly married to the idea of, you know, this or that loan type. We just thought we would do better underwriting because we could do it in real time. We then said, well, we have 4 computer scientists starting a lending company. What do we know about distributing loans? Like, well, the one place where you could have a loan is when somebody's already saying, yes, I'll buy this thing and I would like to use a credit product.
Sure.
And then, well, like literally we're competing with a thing that was underwritten on average 3.5 years ago. And by the way, a merchant price that was set by some independent Salesforce salesperson who sold you a box that is like literally from 1980s with a integrated chip on like 8 generations ago. Like that thing is like, it's not computing anything. It's just collecting an MDR. Like, so if we could float both the MDR and the APR, we could like really, really find the perfect approximation of the risk curve. So that's the origin story. That's where it came from. The thing that actually doesn't get a lot of airplay And it's worth highlighting in terms of like what turned out to be important. So there's a hypothesis, right? Like, so we were like having lunch in our favorite Middle Eastern place and sort of bantering around. Wouldn't it be cool if we found out what? So by the time we were having this conversation, random forests were like not just a thing; there was everyone's thing, and the modeling for that was like, okay, everybody's doing it now. So like, well, so what's like the latest hotness? What should we do? And so you looked at gradient boosting and like all the next things that are now, of course, well understood and well accepted. So we could find some interesting area under the curve from this. As we were poking around all this stuff, we basically asked ourselves, like, given that we know that at PayPal we were like the tallest, most intelligent species because we were willing to read these papers and apply all these interesting bits of math, and of course now everyone caught up. So it's not a permanent advantage. So how do you build a more permanent advantage? And so the idea we had, which has turned out to be completely true, is you build a factory to produce model after model after model. So you're not beholden to a single technique. You're not beholden to a single new paper. You don't just read about random forests first and then suddenly everybody caught up. You have to have a machinery to fully industrialize the production of the next generation of model, both in terms of we have new data and so we need to process it differently and learn from it. But when and if there is a new paper or a new technique that sort of kicks you out of your chair and you're like, oh my God, like this is a completely different way to model things, you're ready to just pick that up and go, which apropos today. So we had that moment in 2017, 2018 when Attention is All You Need came out.
Yeah.
And so every one of us who's in the industry said, wait a second. I thought like, first of all, when we were doing this at PayPal, I remember trying to build a neural network driven way to detect fraud and fight it, and it totally flopped and like just not functional. And it comported well with my experience in college doing this stuff, where like, yeah, neural networks are like, they're supposed to be a thing in the 70s, and I went to college in the 90s and they still weren't a thing.
Well, again, it's science fiction, totally. Right? Like these things sometimes take some time.
I remember reading The Age of Thinking Machines and going like, oh my God, like it's here now. I just need to build a bigger computer. And we built a lot of big computers in the 90s and nothing happened. And then in 2017, it did. And it was this amazing moment where suddenly like, wait a second, you can actually build a simpler thing, a lot simpler than some of the earlier networks that people were playing with. And it really seems to work. And so the thing that we were able to do at Affirm is say, all right, so like, obviously we're not in the business of chatbots or LLMs, but we are in business of building new models from the latest scientific ideas and observations. And so we have been building models based on a lot of the ideas from Attention is All You Need and sort of surrounding papers before and after. And we have some really stunning results to show for it. And so, I don't want to front run anything too exciting here, but we've been consistent in our ability to stay ahead of the research with the most cutting edge research, because we invested in building out this model building factory, which has just been an really, really fun thing to be a part of, to be honest.
Yeah, no, I'm sure. So, all right, I have two questions based on that, because I think that's really, really interesting. I want to come back to transformers and Attention is All You Need as a new sort of technique for making decisions, because I think there's a whole bunch of really interesting stuff there. And without giving anything away, I am curious to get kind of a high level readout on that. But before I do that, I do want to poke at the model building factory, because I think that's really interesting, right? Like, if the idea is, we live better through mathematics, I've noticed a similar thing that I think you're describing, which is that someone finds the thing that's cutting edge that will differentiate them, but they kind of fall in love with it specifically, not the process of finding it, but the thing, right? And so, like, I was going to circle back to Capital One, like, the advantage did disappear, right? When people figured out what they were doing, suddenly like that arbitrage opportunity was kind of gone. And, not that those guys are not still really good at what they do, but you can kind of tell that like generations of these improvements kind of get frozen in time, because they're like, well, now I'm a random forest guy, and the way I process the world and think about data is all through the lens of like random forest. I'm not willing to sort of change my mindset there. So when you think about it more from it sounds like almost like an industrialization perspective internally, how concretely do you do that? And in particular, I think one of the things I'm interested in is like, how do you stop people from falling in love with a way of solving the problem rather than like the search for the best way to solve the problem? Because I think that's a very human tendency to kind of like fall in love with the tool that you like learned and mastered at some point in your career.
It's definitely, I mean, one of the reasons why AI is not taking any of our jobs, or not many of our jobs in my foreseeable future, is because ultimately the question you're asking, and like many in that class of questions, are very human. Like it is, you can program an AI to do X or Y, and you can tell it to try to be creative, and it'll sort of span the between X and Y. But to get out of the box,
Sure.
you need creativity, which is primarily curiosity, intuition, and taste. And we're pretty
Yeah.
far from encoding taste. We're quite far from encoding intuition, and curiosity can be programmed, but curiosity in and of itself is not enough. You kind of have to know which lines you're going to paint outside of. And so the way we try to encode those three behaviors inside our very human team is combination of just challenging them to ask, are we plateauing or not? And you need metrics to tell you, yes, you are, or no, you're not. And so there are some great, well sort of agreed upon metrics in statistical learning and AI and sort of all the, I mean, this is a well-studied area of math.
Yeah.
And so
Yeah.
you have that very same area under the curve where you can look at how the model ability to rank is progressing and ask the
Sure.
question, so how much better has it gotten from version N to version N plus one? And if your area under the curve improvements are gently asymptoting towards nothing, you're
Sure.
not winning. You're doing
Yeah.
fine. You're not losing, but
Yeah.
everyone
Yeah.
else who is
Yeah.
taking these leaps forward is catching up, definitionally, unless
Yeah.
they're asleep at the switch.
And you're kind of thinking in the back of your head, like, if we're like kind of flattening out, there's someone behind me who's going
They're
up
just
a hill
earlier in
like
the
this.
curve. Like you got to be very aware of the
Yeah.
fact that you're not the only one competing. And so every year, every 6 months, we ask ourselves, what have we not tried that at the downside would actually bring the area into the curve down? Which is okay because we already have this performance and it's great and we love it.
Sure.
But what's the
Yeah.
high beta thing to do? What crazy thing can we pull out of a bag now? For example, can we try something that's transformer based? Yeah, there's all sorts of risks, and like not just like what if it doesn't work, but also what if it run? It's a sort of classic thing to worry about with transformers is hallucinations. And so, like, what if it hallucinates a result that isn't real? What if it hallucinates a result that isn't compliant? So there's all the very, very serious things that you want to worry about as an underwriter, and certainly somebody who is subject to all the relevant underwriting related regulations. But if you don't try it, you're not going to find out that it's working. And
Right.
that's how we keep ourselves honest. We ask the question, like, given what we know about the industry, if for this particular family of models, the curve is bending towards flat and we know everybody else is chasing us, what new curve are we doing? And by the way, this logic, it has to apply not just to underwriting, but also to product. Like we have a
I
very
was going to
similar
say,
approach to product building, where every time we look at our growth curve, we ask ourselves, all right, so if we are just the first in a pack, who's behind us and how far below the elbow of this particular curve are they? Because if they're not that far, we better be inventing a new curve.
Right, right, absolutely. Well, and on the subject of transformers, because you brought up hallucinations and stuff, I actually think even setting like the hallucination aspect of it aside, one of the, I guess, kind of philosophical questions that I wrestle with a lot with all of these capabilities, not just transformers, but earlier innovations within the field of artificial intelligence, is like almost the interaction between like our societal expectations, the sort of expectations that regulators have, and then like the outcomes we're trying to drive, right? And so like one of the words that I always think about a lot in this context is explainability, right? And explainability is fascinating to me because, in the 1970s, when a lot of our like fair lending laws were written and FCRA was passed and all these things, there was a very different way that all of these decisions were made. None of them were made using computers or statistical modeling or anything. This is obviously even pre-FICO. And like in that environment, an idea of explainability, I think, had a lot more to do with almost like how do we hold a human being on the other side of the lending desk accountable to that individual?
It's basically
right?
enshrining the fact that we are all biased as a species. Like, you sort of look a lot like me, alone for you.
Right.
And that lady over there, I don't know. I just don't know. And like, you can see like 1950s people like, you're not from around here, are you? Like, I'm not sure I can trust you.
Right. As code for like me sorting things in my human brain between things I think are a good idea and things are a bad idea. And so it's like, you can imagine that like, okay, well, if we say that everyone is due an explanation for the decision that's made, maybe just the verbalization or the writing down of that reason will sort of act as a way to kind of modulate this behavior and hopefully correct for it a little bit. And again, I think a lot of the laws that were passed that then were very smart about those kind of problems. But you fast forward to today, and it's interesting because on the one hand, when I look at like transformers and LLMs, I see a technology that could be vastly better than what we do today in terms of explaining to a customer, like, here's why you were approved, here's why you were declined, here's what maybe you could do better or differently next time. And like giving like personalized, customized narratives that are way better than like, quite frankly, like a reason code coming out of a model. Like that doesn't really tell you much. But by contrast, I think like an interesting trade-off, and this kind of gets to like almost our societal idea of fairness and explainability, is we might not quite know deterministically exactly why the model did certain things in a way that we maybe were used to knowing before. So like how, and I guess this bridges us into a conversation about regulation, which I did want to get into, but like when you think about applying those ideas that are sort of like both a principle, but also a principle enshrined in very specific regulation written decades ago to evolving technology, like how do you sort of think about that?
Lots of good threads to pull on there. So I too use the word explainability all the time. Over the last sort of couple of years, as I've been looking at all the latest greatness in AI and ML, I've become more and more convinced that we'll probably solve explainability really, really well, specifically with LLMs and things that are sort of hang off the LLM tree, if you will. The most interesting problem that I think needs to be solved for this new class of models to be really sort of to come into its own is replayability, which is it's sort of a code word for getting a different result while running a model with the same exact inputs. Why FICO is so valuable. It's stable. Like it's actually too stable in my opinion for a variety sort of applications. Like, but it has to work like a few years at a time without costing lenders too much money. A firm's internal transaction score, internal user level scoring system that we've built, so like half a decade after we built the transactional one, they're significantly more sensitive, but they rely on real time data. And so, but they're 100% replayable. The same exact real time data runs through that model will give you exactly the same decision, same score, same everything. And so, I think that's the bar you have to meet with these transformer. Like again, like we're throwing around terminology, and I'm deliberately being vague just because I don't want to give anything away to my esteemed.
Well, and then if you were too technical, I wouldn't understand it anyway. So we're in great shape.
And so, but I think this explainability thing is actually almost like a downstream problem from replayability. And replayability is a navigable part of these models. You can go back to there's some really great papers out there, like very recent, like last 30 days that I just looked at, that were sort of dismantling this notion that in the older versions of GPTs, which are now just one of several contenders here, if you set temperature to 0, you would get the same exact response every time, right? The answer is wrong. If you actually set your sort of the randomness factor from the possible candidates for the next token, you just always pick the very, very top one. Don't mess around. You'd think you'd get exactly the same response. And the answer is no. There's some really fun kind of, if you remember your sort of college days, sort of numerical methods is probably the name of the class that you would have to take to sort of know what I'm talking about. You will immediately recall things like fixed length precision. So you have a 64-bit float, and like you decide that of that, maybe 48 bits is going to be representing your floating point, and that's like 48 bits of precision. So if you need a 49th bit of precision to define a float, you don't have it. It's going to get rounded down to 48, and that's it. And so, and by the way, a lot of the modern models actually use like 8-bit precision. So they're like much, 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 much more narrow. And so because of that, you have compounding of errors and all that good stuff. So you actually do end up with some fairly easy to understand ways for why hallucinations and lack of predictability, lack of replayability were a thing. But then there's more.
Yeah.
I'll stop there because it's like I was like, whoa, this is blowing my mind, and like I thought I understood it, and
that's fine.
I forgot which lab put it out, but it was sort of like a thing that I thought I understood better than the average bear. I was like, all right, I came in here thinking that I got this, and I'm walking out knowing that I know I don't. I know more now that I read the paper. Anyway, but.
Well, that's first step to wisdom is, realizing you don't actually know.
Yeah, I thought I sort of left my arrogance, checked my arrogance at the door at the founding of a firm, but it turns out that I still got arrogance to give up. Anyway, so but back to the more tangible, maybe easier to sort of to reason about regulation side of things. So I actually think a lot of it, this will sound like totally upside down from what maybe as a Silicon Valley entrepreneur I'm expected to say, but first of all, I think regulation is more good than bad in a lot of cases. Some regulation is dumb. Some regulation is outdated, like profoundly outdated. And it's mostly when the regulator or the writer of the regulation, which is frequently enough not actually the same person who's charged with enforcing it, writes things down almost too literally. Like, thou shall not use an 8-bit integer, only 16-bit integer will do, is like total lunacy. If you ever see that in the regulation, like that is a dumb regulation, because before you know, by the time it's written and published and enforceable, 16-bit integers will be like a thing that no one ever cares about, because you have 128-bit integers now. And so like anytime it gets super specific as to the implementation of the regulation, it always ends up falling short, in my opinion. On the flip side, things like you can't discriminate against people based on who they are. You should be allowed to do so financially based on what their financial state is really sound. It made sense when they wrote down the very first words of fair lending, and it's still true today. And so the hold yourself to the standard of don't discriminate based on who the person is, where they're from, what they believe, who they marry, like all the sort of obvious things that we take for granted now, but did not take for granted in the 1950s.
That's right.
I think they're still true today. And that serves us really well. And the thing that is not in the law, which is great, it doesn't say things like, and by the way, if you're doing this with a computer, different measuring stick. It's like, I don't care if you're doing this with an abacus or in your head or with a scorecard or a FICO score. If you end up discriminating based on race, that is not okay. And full stop. And so I think that regulation is like fantastically great and doesn't need any words changed. I think some of the regulatory attempts to sort of corral technology into technology understanding of the moment frequently backfires, because technology moves faster than the regulators can, and that is how it should be. You don't want to change regulations too often because too hard to enforce. And so that's sort of the basics. And the reason, by the way, sort of my philosophy on regulation writ large, not just in financial services. So I grew up in the Soviet Union, and so that means I saw Eastern European flavor of socialism up close and personal, and it sucked. Like, there's anytime someone tells you, it worked in Nordics, it's okay. Soviet Union almost got it right, but then they no, like it doesn't work. It's inherently corrupt. It's the idea that everyone's equal, but those distributing the money get to keep a little bit more than others is just like that. That's abhorrent, and it is exactly what happens. Like, the classic joke about Soviet Union was that people who ran grocery stores were always fat. Just figure it out. Like, maybe they stole from the shelves. Maybe it was genetic. One of those two. And so socialism does not work. And yet free market economies, though they self-correct, they sometimes take too long. Like the classic example of the pizza shop that doesn't sell to gays is like, wow, that's really offensive. Fortunately, there'll be another pizza shop next door that will sell to gays and have a big rainbow flag. It'll be great. Yeah, but in practice, how long before the second pizza shop opens and kills the one that is prejudiced and bad and et cetera? And I think in practice, a regulation that says thou shall not discriminate based on creed or sexual orientation is actually a pretty good regulatory thing to do, because it just runs the fact, like most of us understand, it's actually like not cool in the 21st century to discriminate based on something that's completely unrelated to what it is that you do as a business. And so I think
Totally.
that's the sort of like speed up towards normal, sane, not stupid way of the world, perhaps pushing the market along versus waiting for the market to get there. That is, in my mind, the primary purpose of the regulation, of any kind of regulation. And so as a consequence, generally speaking, if it's thoughtful, if it protects consumers, if it's there to speed towards the natural equilibrium that most reasonable people can agree should be there, big fan. Like, let's have more of that.
Yeah, no, absolutely. Well, and I wanted to ask you specifically about kind of building on that general philosophy of firms' approach, particularly in the early days, to kind of engaging with regulators, right? Because I think, you talked about technology being something that you don't want regulation to be too prescriptive about, because then it like freezes and like it just becomes really, really hard to kind of wrestle around with. I think a similar argument that's really interesting is like product structure, right? Because, on the one hand, I think you're absolutely right. Like these principle based regulations of like, if it has these characteristics, it's a loan, right? And if it's a loan, we think these things are fair. You notice, and I see this, I've seen it in lending, I see it now in crypto, I see it all over the place in fintech, just over and over and over again, is there's some clever lawyer somewhere who's like, the way that this like principle has generally been interpreted means that if we structured our product this way and not this way, we could skip all of these steps and not do this. And, that's what lawyers get paid for. And particularly, I would imagine, and you would know better than I would, but like in the early days of building a company, you're not going out of your way to try to go through more steps than you have to. And you probably are sort of looking for the fastest way to get to market or to scale. But what was your experience, I guess, in kind of helping to pioneer buy now, pay later as a concept, and then more narrowly as a set of different product structures and like fitting those into regulation? Because I know, just having watched it from the outside, like there was a lot of debate around that over the years.
Yeah. And there's definitely no one size fits all. And if you want to be truly risk-free, stay home and don't start companies, because then
right.
That's one way to do it. We did a couple of things, and they're not exhaustive in a sense that we did even more than I'm about to describe. And as I go, I'm sure I'll think of more, and on this will go until you stop me. So one of the very first things we did, we basically said, we should not do late fees and compounding interest in just, we won't do that. And you can actually mount a reasonably good argument why that's a dumb idea. So late fees are there to slap your wrist and tell you, hey, stop being sloppy. You should pay on time, because when you're not, everyone in the system is paying a tiny amount for you to have the freedom to pay whenever the hell you want, instead of actually sticking to a schedule. And I think that's actually true. Like everything I just said, I happen to believe. Like it's as a libertarian, or at least I was probably more ardent libertarian 25 years ago, when I was also a lot more arrogant. Hopefully I've become slightly more humble and aware of other points of view. But that argument stands the test of time reasonably well. The reason not to charge late fees more than anything else is twofold. One, it profoundly aligns you with your customers as far as financial well-being. If you charge late fees and the user or the borrower is late, you'll make more money. So there's kind of every contract is basically a little bit of an agreement and a little bit of a bet. Like, I bet you'll be good for the money I'm going to give you a loan, and you bet that I won't screw you when you are late or something bad happens and you can make your time of payment. In the normal world of late fees and compounding interest, where the bet I'm making is like, you think I'm on your side. I hope you don't notice that I'm not, because I want you to over time pay me everything back, but I kind of want you to be late, because then I'll make more money. And the marginal cost of that gain is nothing. Like literally $38 for you to skip a day of payment is like an amazing business opportunity for a lender. And
totally. The margin on that is crazy.
It's basically infinite. And so the argument we made was, if we get to make money only when consumers behave in the way that we ask them to behave, versus ask them, but wink, wink, don't do this too frequently all the time, we would build a better underwriting engine. And so as an incentive not to screw up, to build the best approximation of the risk curve, we should keep ourselves as pure as possible relative to the revenue making opportunity of a lender. That is, if we say we're going to loan you $1,000 and you'll pay us back 50 in interest, that is the most we should ever have. No fees, no late fees, no compounding, no deferred interest, none of the sort of a cool bets where I bet you'll be on time, but I bet you're going to be less on time than you think you will be on time. And so that's sort of the product innovation there came entirely from this, let's just be purist because it'll force us to be good. That's sort of part one. Part two, because we knew we were building a completely new class of products. So you're totally right. As we were doing this, I would sit down with a partner bank to be or a law firm to hire and explain what we're trying to do. And like the reaction was inevitably the same. Like, okay, so part one, you're not charging late fees. You're going to lose your shirt. That's like half the profits in the industry. Like, don't be an idiot. Like, but like, we made a decision that's what we're going to do. That's how we're going to do it.
Sure.
But more importantly, or more sort of relevant to the second part, they would say things like, okay, I don't even understand if this is a loan. Is this a retail installment contract? Like, is that what it is? Like, no, okay, it's not a line. So you have to show truth in lending disclosure every time. But like, you don't want to do that, do you? Like a truth in lending disclosure for every purchase in a store, like that's just going to slow everything down. And in that moment, I sort of had a choice to make. And I said, no, actually, we are going to show a till every single time. You're totally right. It is going to be something like a bump in the road. But I think if we're claiming that we are completely on your side, there are no late fees, there are no compounding, et cetera, an extra screen showing you that you will owe nothing extra will maybe slow you down a tiny bit. But one, will make you feel like you're making a more responsible decision, give you more sense of control, but more importantly, give you clarity that we're not just like marketing ourselves as a no late fee company. Like we really will commit to you in a formal way that there are no late fees. And so that's sort of like, I convinced myself in the moment at the time that this is going to work. Like it's going to be okay. Like conversion is not going to suffer so badly that like
you're talking to a law firm and they're like losing their minds on the other side of the table. And you're like, no, I think this actually makes sense.
And, and so as we did this, I met with a bunch of regulators. Like this is, quite some time ago now. And they all asked me to the person, like, hey, so like, how are you cheating? Like this and this and this, like, are you doing any of these things? Like, no, like I really am not. Like we're building a product that's just going to not be a cheat code. And the more I talked to them, the more I sort of understood that most of these people became regulators because they genuinely cared. Like they're not like these, like I'm a lawyer and so I need to wield a stick and find bad guys in the industry. They all came to it from the place of there are people who are just too busy, too tired, too overworked to read the fine print. And my job as a lawyer to protect them, to make sure the fine print doesn't say anything too horribly nasty. And that actually influenced one of the core values we have, which is no fine print. Like I literally had this conversation enough times, like, you know what, we're just not going to have fine print so that people who regulate us don't have to read it. And the consumers, more importantly, don't have to read it. Anyway, so my regulatory experience or the relationship was really shaped by these early conversations where like, I am not trying to find shortcuts. I really want a product where people feel great about using it. So as I was doing this, and we're trying to build a team, so part 3, and I really will stop because it's all sort of the memories are flooding back. This is great. I remember starting to talk to sort of early engineers. And of course, as we were building our AI team, I really wanted the very, very best people. So at PayPal, because ML and AI were so underutilized, we had this total pick of the very best people in academia and the industry, and it was great. By the time we were starting a firm, Palantir was a thing. Everyone wanted to hire really great ML engineers. And so I was trying to ask, like, so where will I find a gusher of people who are just really good in machine learning and artificial intelligence and are interested in what we're doing? And I realized that it probably a lot of people who would normally work at a quant fund who would go to Wall Street and like build these major scale models and train them on like very proprietary data, because we knew we'd have a ton of data because we're embedded at the point of sale. It'd be really interesting to train these things. Like, so where do you get the best people? And so the thought that came to me, which turned out to be exactly right, is if you build a product that they're not embarrassed to talk about to their parents and friends, they wouldn't go for the money, because like I sit on Wall Street and I squeeze pennies out of the market and my job is efficiency of capital. That's a cool story.
Totally.
but it's like shorthand for I make a lot of money pushing bits around, trying to find the next transaction that the other guys haven't caught onto yet. What we're building is actually helping real people buy real things at like, states that are not party to this Wall Street bonanza. And so if you have that connection to, like, if you didn't come from New York or LA and you're not just like naturally drawn to the Wall Street like money making, you're like, I love the idea of helping people like my parents or people like my cousins come into whatever it is they need to buy. And I feel great about building machine learning models. I just don't love the lending world. It's like, well, this particular lending world is unlike anything you've ever seen. It's no fees, no screwing the customer. We have this extremely high sort of brow mission that we really believe in and care about. And we're not afraid of the regulators. We love talking to them and explaining who we are. We like responding to information requests because when they say, please disclose all your fees, you're like,
that.
Cool,
yeah.
A sheet of zeros, please. And so the early team foundations, especially on the engineering and ML side of things, was really this like, hey, you will be proud of what you do. Like, you will not be embarrassed by who you work for or how we do our business. You will never have to own, oh yeah, I'm sorry, I'm the one who like give you the 0% with an asterisk clone. Like, we don't do those. And like, it's exciting to be in that team. And so those were the three kind of foundational trends that fed our choices on the product construction.
That's really fascinating. And I actually did want to ask you about that because it felt like and you brought up the Wall Street thing, which is exactly where I wanted to go, which is like, it's the flip side to the better living through mathematics thing, right? Which is that like the challenge with math, and my mom's not here, but if she was, I think she would still agree with this, is like, you can get a little lost in the sauce in terms of like, I'm just playing a game. The goal of the game is to maximize this output. And like, you sort of start to think in very abstract terms. And I see that a lot on Wall Street in particular, where it's like, I don't think it's like with bad intent, really. It's just like, it's so abstracted away from the real world that it just becomes sort of a game that you play and the goal is to win the game. And as a byproduct, some markets may end up getting manipulated. People might get hurt. Like, those are just like things that are sort of someone else's thing and not mine. And unless I go to dinner after the great financial crisis has like broken, I'm probably not going to like feel that necessarily on a day-to-day basis living in New York. However, like, you also brought up this idea of sort of incentive alignment, right? And I wanted to ask about that because I love the honest financial products that make people's lives better. I think that's an awesome mission. Everyone I talk to at a firm seems really like genuinely bought into that mission in a real way. But I also know, and particularly being like a public company and stuff, like the incentives of like hitting numbers and doing certain things on a quarterly basis, like people are always creatures of incentives. And I find a lot of times when I ask people about like their mission, they'll describe it in very like cultural ways, but they won't describe it in like systemic or like structural ways. And I'm curious, like, how you think about, particularly as a firm has really grown and you don't have your hands on the wheel for every one of these decisions or even like very many of them at all now. And it's, the company is moving fast. How do you sort of make sure that that mission stays aligned with like the structure and the incentives in the company?
So that used to be like a major worry of mine because when we were tiny, I was in everything. Like, I would stick my fingers in every pie.
You were in every meeting, signing off everything.
And back in the day, like, we would hire product managers and I would tell them, like, you get one question to ask me about late fees. Like, I know you came from financial services. Like, people who didn't come from financial services just didn't have the affliction. But if you spend a lot of time in financial services, like classic FIs, you'd be like, so you guys don't charge late fees. There's like a lot of money in there, right? Like, yes. Let me explain. Here's why. We want to align ourselves with our customers. Like, okay, cool. Like, that was your first one. You can ask me again.
Yep.
And if it's the same question, you'll be fired. And if it's the same question, but like in an interesting, new, thoughtful way, and you had an insight, and like, if you want to make the argument for like, you're just stretching the cost of time value of money across the entire user base, like, I'll humor that. But it's just like, I thought about it, and we should charge late fees because it's more money. Like, you should not work here. Like, you didn't get it.
Fit.
And so that was like year 1 or 2. And, it's now almost year 15. And it is true that I'm not really involved in hiring every single product manager or any sort of, I still interview quite a number of people, but mostly not. And so it turns out that if you are completely obsessive about the cultural DNA of the company in the early days, and you just never ever compromise early, it actually becomes a self-sustaining thing. This is the experiment that you can only run once. So I don't know if this is true for everybody, but if you look at the average tenure of senior people at a firm, so Libor, our president, so he's responsible for both product and engineering these days. He started as CTO and kind of just and operations and risk, by the way. So he's picked up a lot of things over the last 10 years that he's been here. He was also my college friend, and so we've known each other for a very long time. And Michael, our chief operating officer, who is now his 7.5 year in, and Pat, our head of sales, who is like 10.5 years here. So you have a lot of these figures of importance and authority and, like key sort of a cultural significance. They all bought into this, and they weren't just like, I didn't just interview them. Like I was there with them, incubating the product ideas and making mistakes and realizing that we built something that nobody cared about, or built something that really took off, and handling internal objections to why don't we do X or Y. And 10 years ago or 12 years ago, somebody asking me like late fees was kind of obvious from the very beginning, but there were plenty of other like a much more subtle, like, why don't we do this or that? And at some point or another, they're like, I don't know, but I'm going to have to go think about it pretty hard because this is like an important culture setting moment. And sometimes I thought, yes, this makes sense. And other times I didn't. But in the early days, you embed all these decisions in the popular conscious of the company. This is the shared DNA. And as you get to 2,500 people, which is where we are now, you have a lot of people who have been there through the years of this sort of crucible of what is a firm. How does it do when this kind of a moral problem or moral hazard floats up in front of us? And so it's more than just me. In fact, I used to make this joke, and now that I'm in my 50s, I actually become maybe slightly too sensitive to it. But like if like a lightning strikes me, to sort of not make it too morbid, I don't think a single thing would change. Like I think the company would just self-enforce the DNA with or without its founder. I'm probably one of the more passionate people about the sort of like the way we do business. But I think I'm far from the only one. I don't think it's like this one Max holding up the dam of late fees. It's not quite the opposite. I think if anything, lightning strikes me or it becomes senile, which was the 50-year-old joke, and start asking my own questions like, why don't we charge late fees? Seems like a really profitable thing to do.
I was gonna say they might like they'd rebel against you and lock you in your office. Yeah,
they would like literally toss me off a cliff. It's just like, okay, the old man's lost it. Like we got to get rid of it. Like we are the company that does not charge late fees under any circumstances. And so I think it's like so enshrined in who we are and how we do what we do that it's actually like entirely life of its own. Like I used to take great pride in the idea that we never changed a word of our mission. Like the mission, and it's fairly awkwardly written down. Like I wrote it kind of off the cuff and it was like, all right, cool. Like on a napkin. Honest financial products that improve lives. Cool. Like, I like it. Let's go with that. Yeah. And like 2 years later, like, we should probably change. Like, it could be a little bit more clever. Like, maybe pithier. And so I was like, no, you can't. Like, it was like written down when you were starting the company. And like 15 years in, like, I can't change a word. And if I did, somebody would be like, oh my God, he is like modifying the mission. A comma has been introduced. It's like, right. He's compromising.
Yeah. Can't do that. I think it's like the Declaration of Independence.
That part is actually, I'm okay with this part being calcified. Like you cannot allow calcification of model building techniques or willingness to chase the latest hotness in machine learning. But like calcifying a great mission, totally cool.
That's a good way of putting it. So the other thing that is kind of a little bit, I would think of like a balance or a tension that I was curious to ask you about. I mean, obviously, I got to know you guys originally when the business was very like merchant focused, which is kind of where you started. But now, whenever I tune into earnings calls or kind of like look at what the company's up to, it's a lot of B2C. It's a lot of consumer facing stuff. Obviously, the Affirm card is like a huge centerpiece of that. I'd imagine there's more stuff kind of in that vein coming at some point down the road. And, it's funny. I mean, I think it's challenging anytime a company decides to do two things that are just completely different motions, like rubbing your stomach and patting your head. Like there's just an element of like, you don't want to do too many of those things at one time. And, I would think, and you correct me if I'm wrong, that like probably in the early days, there were at least some conversations with merchants about like, hey, why don't we like white label Affirm? And like, does Affirm's brand need to be like front and center? Like, can we talk about that? And I guess I'm curious, like, well, first of all, do you think of Affirm as maybe more B2B versus B2C? Is it like an even split? And then second, like, why are both sides of the business kind of important to the type of company you want to build over time?
So it's actually refreshing to hear your analysis because it's wrong. But like in a
that's
but
good.
that's actually like it's wrong and it's right and it's wrong. So
okay.
From the very beginning, the sort of the North Star, and when you're trying to build a thing that doesn't exist, like you're always leading into analogies like, well, we're like Uber, but for songs or something. I don't know. And so I was trying to explain to our earliest backers, like, what are we going to be when we grow up? And the shorthand was always, we're going to be like American Express, but in like 21st century technology, where you would see us both as your source of credit, but much more importantly, as a network where more and more consumers would find us on more and more merchants, and then assuming this idea of honest financial products, no fees, no screwing around, no gimmicks, you would prefer us. And so as your preference for our firm would grow, so would the number of merchants saying, well, I can't ignore it. It's just too many people who like this thing so much. It would create a flywheel of more consumers that like us because we are honest, would naturally grow into more merchants. More merchants would then essentially act as an advertising engines for us, with more consumers saying, I've seen this logo before. It's on a bunch of places now. Gosh, I've seen it on Amazon. And so it would just be a flywheel. So we've always had this point of view that we are building a network and one side has to reinforce the other. In fact, I mean, we are a much larger company now than we've been through the years, but we're still inevitably engineering constrained. And so as we prioritize the next thing to build, the first question I ask is, does this help one side of the network or both? And if it's both, that is the highest value thing we can be doing. So building, like, we could offer our consumer something like really, really neat. Like everybody gets a free hat. How are the merchant going to care? Like they're not. Like, okay, it's nice that everybody gets a hat, or I don't know, access to airport lounges. That's great, but like that's not really helping the merchant side of the equation. It probably helps consumer retention, makes them feel like we care for them even more, which we certainly do. But a better version would be something like create a platform where all the merchants can promote their discounted APR deals. So we had this really cool thing called Big Nothing Day, where we're like the entire management team, but also the company's like really big into silly puns and strange, funny movies and things like that. So there's a fair amount of like goofiness going on. We're a very, very serious company.
Yeah.
So if you're as serious as we are about math, like you have to take it out elsewhere.
You have to lighten it up.
So a lot of my shareholder letters make references to the Big Lebowski and things like that, which my pronouns are El Duderino and so on. Anyway, so as we built our app, we thought, like, what was it used for? So initially, the use of the app was, of course, like pay your bills, set up your auto pay, all that stuff. And then it's like, well, we might as well make a catalog of all the merchants that allow Affirm, because that'd be great. Consumers would be able to find, like, if I'm going to go to store X online or offline, is Affirm available? Then I'm like, well, some of these merchants offer 0% APRs. And that's really great. And we should let them highlight that, at least in our app. And so about a couple of months ago, we had this idea, like, why don't we have like a big festival where we have a day where any merchant that wants to offer 0 will do so. And we will make it our business to tell all of our consumers that, hey, these merchants are offering 0% loans, and like 0 interest is the best price. And of course, this being Affirm, it's not like 0 asterisk secret message. It's like 0 means 0. Like you're paying for $1,000 thing over 12 months and it's going to cost you $1,000, which is pretty flipping good. It's like better than any credit card can possibly offer you. And so, so that's what we did. And it's like a great example of a thing that we built sort of whole cloth from nothing over the course of a few weeks. And then over many months, we actually signed up a bunch of merchants who wanted to participate in this sort of extravaganza of zeros. And it was huge. Like people loved it. And it was, very, very good sort of explanation of like who we are to our consumers and to our merchants at the same time. And so this like singular moment, singular set of features, singular set of productization is a good example of how we think about building products, and why like the card and the app and the point of sale and all these things, they all play together to just further the spin of this flywheel of more merchants care about accepting Affirm and using our 0% and other promotional capabilities that we offer to inspire more consumers that will come back and shop at more of these merchants and feel good about how they're buying it and make sure it's affordable and there are no late fees and all that stuff. And so that's like the crux of our product strategy, our network building strategy, all of that. And so that's why I was sort of chuckling at like, yes, we are like, we were very much a merchant company because we wanted merchants to believe that we will bring them more sales.
Sure.
And then we did. And then we had a lot of consumers, like 24 million of them last quarter, 12 months trailing. And that's enough now for merchants to be like, I should offer Affirm. Like, having just Visa, MasterCard logo, like that's not enough. Like I got to have the Affirm logo too now on my door. And so as that flies on, it becomes like, well, we're now like much more of a consumer company, aren't we? Because like we have this app and the card. And of course, like the more of that we have, the more merchants are like, whoa, like I definitely need to make sure Affirm is available. So I
mean, the next question you get like a year from now will be like, boy, you really seem to be like leaning into merchants. And really the story is like this pushing on one side of the flywheel, pushing on the other.
We have two hands and we're pushing both like in the same direction.
No, that makes sense. And then I guess the other thing that makes me wonder about, and I know you've compared Affirm to kind of a modern day Amex for a long time. And I like that analogy a lot. One of the things that I've always been fascinated with any network business, and Amex is a good example, is I sort of view the world as like good problems and bad problems, right? Like you're a CEO, you're going to have problems every day that you have to solve for. But the question is like, what's the portion of like bad problems I have versus good problems that I was like dreaming of having 6 months ago or a year ago or 5 years ago? And I think that like when building a two-sided network, you create a lot of good problems for yourself, right? Because like there's always these things happen, right? Like a merchant wants you to say yes more, but you might not think that's the best thing for the consumer, or vice versa, or like different merchants want different things that might conflict with each other and they compete with each other. And like whenever I look at any network business, I see a whole bunch of like, we get the privilege of sorting out these conflicts or these problems. And, even like with the Affirm card, you guys announced a partnership with FIS to make sort of the Affirm card model something that any bank that offers a debit card could offer, right? Fantastic. But you are creating some type of like cannibalization or conflict sales channel problem for someone in the company to deal with. How do you think about like solving these like good problems to have and like navigating the conflicts of operating a network?
So that particular one and like a class of these problems actually is kind of very familiar territory. So long before we had this, so the eternal name for this project is ACDC, which I did not name, but it's one of the better names I think we have, and it's Affirm card on other debit cards. So it's
ACDC.
And I'm sure it's being marketed. I thought it was great.
That's good. That's good. Another T-shirt. Yeah.
Yeah, that's a good call, actually. I'll come to you for all T-shirt ideas. I have
merch. Fintech merch is a bit of a passion of mine, so I'm always.
I usually sport at least two, more often three Affirm logos. Like you will not have a photo that I just took in front of 10 Downing Street in London, where I was fortunate enough to be invited to speak with some very very senior people there, and I had to wear a suit and tie, and so I was like, oh my god, I feel naked. There's not an Affirm logo on my body, so I snuck in Affirm socks. So I have a photo of me in front of 10 Downing Street pulling up my leg cheekily, showing off like, just so you know, Affirm socks are there. Anyway, so
it was here. Yeah,
I would not be seen without it. So the point on navigating this class of conflict. So long before this ACDC became a thing, we had the kind of a natural channel conflict. So we are embedded in Shop Pay and in Apple Pay and in Google Pay, and we are directly integrated sometimes, or a lot of times now, and so on. And so one question you have to ask is, inevitably, some of these are better than others. Maybe some of our partners are more successful at negotiating a better deal with us. Maybe we're more successful at negotiating a deal with them. And so like the economics are like, they're similar, like they're, it's a payments business. So there's some natural constraints as to what it can and cannot happen, but you're going to have channel conflict. And the honest answer that you have to give, or the question you have to ask and the answer that falls out of it is, so what's better for the end consumer? So clearly the merchant decides like, I'm going to put up N logos on my site because I know my consumers are excited to pay with Shop Pay. Like Shop Pay is the best converting wallet on the web. Like what they sometimes say out loud. It's almost certainly true. And that's what those sites prefer. But like, they're not crazy. They're not going to exclude Apple Pay or other types of pays because people have preferences. And so our goal was always like, look, we need to be available behind every door. When you push on a door that says payments here, if you find Affirm there, it has to be about the same experience. You have to know that you're getting the no late fee experience and everything else that's sort of behind that. And
that value prop has to be the same.
And it can't be like, actually, if I knock on this door for this partner, this wallet, I'll get like a better Affirm than the other Affirm because that other Affirm has been nerfed. And so the notion of channel conflict between wallets and other financial services where we are embedded has long been with us. And we've long navigated the good problem of how do you cope with people sometimes look for this door or sometimes for that door when they choose their wallets, and Affirm is in both. Like, you just make sure that the merchant gets the same value and the consumer gets the expected user experience and the value. And so as we did this, we sort of asked ourselves, all right, so in the world where people have a preferred debit card and a checking account and a bank relationship that they're just never going to walk away from, like, do we want them to have Affirm card? Of course, that'd be lovely. Affirm card goes to the people who are like really, really committed to Affirm. They used Affirm a bunch of times. They love it. They're like excited to go use our card for everything. There are plenty of people that say Affirm is great. I use it in 12 different places per year. That's it. And for other things, I have a debit card from my bank X, and like, boy, it's great. I just want to do that. And so as we were reasoning about this, we thought, all right, so like, if that's another door and they're always going to open that door when it comes to paying for things that aren't like considered deeply thoughtful purchase. Affirm is ultimately like where we came from is still kind of where we are a lot. And that is when it matters to you, like when you're thinking about it, you should use Affirm. Like it's pretty clear that if you're looking at a $1,000 thing or a $500 thing, whatever is like a meaningful amount of money for you, when it matters to you to think about it, Affirm is always going to be the best option. Like, no fees.
You wanna win
that is. I mean, I would argue we won that, but like we're winning it. Yeah. You know, nothing's permanent, but we're doing well there.
Sure.
And so that's the strongest kind of a brand and intellectual stronghold of what Affirm means for people. If you have other parts of your financial life, we don't want to tell you like, oh yeah, you know, definitely got to drop your banking relationship. Like, banking is local. Like, you have a deep relationship with whatever bank you go to, wherever you are in the world. And so if we could bring us and what makes us special into that instead of trying to uproot it, I think that's the better path, at least from how we've built our business. Like, we tend to play well with the ecosystem versus trying to antagonize the ecosystem. And so that's where that project came from. And we'd seen a pretty significant amount of interest from folks that are looking from the outside into this BNPL world and saying, you know, my consumers are using these products and I have no idea how I can offer something like this, even though I know it matters to them. So I think that was the right choice for us to make. It also speaks to this idea of a network. Ultimately, what we're doing is we are connecting people who have completely different preferences, like who sometimes love Google Pay and sometimes only use Shop Pay because that's what they're completely conditioned to. And so if we're inside both, it certainly makes sense we would be inside a debit card or inside another payment instrument that, you know, we haven't said out yes to out loud. Anyway, so that's sort of that's the philosophy that led to ACDC, and that's how we're going about it. And it has been, so far at least, the reception has been quite positive.
I will say, and this kind of speaks to like the credit card market and how point of sale lending and buy now pay later kind of compete with credit cards. But I was thinking about the FIS ACDC sort of like initiative and thinking, you know, like if I'm a bank that has a debit card, but is just in no way ever going to be a major competitor in the credit card space because it's so consolidated, like there's very little like benefit to me in trying to build a credit card that even has a prayer of being able to compete with.
It's already happened. People have tried. Like it didn't work.
Right. It just doesn't work. Yeah, I mean, and like there's always going to be some kind of like the PFM thing we were talking about before. Like someone's always going to try, but like there's the dynamics in that market are pretty set. But by contrast, like if you can sort of, to use the Shopify analogy, like arm the rebels, like if you can like give every small bank who has a good relationship with their customer and a bank account and a debit card and sort of supercharge that debit card to make it more competitive with credit cards functionally, I think that's like, I mean, I think that's a very compelling pitch for a lot of the banks out there.
That is indeed the pitch.
And
that is your
okay. Well, no, that makes
if you'd like to have a side career and explaining to banks, like you have the credibility, you come from that world.
Keep me in the loop as the press releases come out, because I am actually really intrigued with this particular model, and I guess it kind of dovetails to another thing I wanted to ask you about real quick, which is, and I mean, you have been in fintech for a long time and you've studied fintech, I think, pretty obsessively. One of the things I find fascinating is this distinction, and you see it with every kind of product all over the place, between how a product is sort of meant to be used versus how a product is actually used by consumers in the real world. And the go-to example I always think of is when the online unsecured personal lending boom kind of happened, and you had Prosper and Lending Club and Avant and all these different companies. They were offering really, really easy access to personal loans, which no one had ever had before. Well, it made sense. There was an obvious arbitrage opportunity to undercut revolving credit card rates and refinance credit card debt. And so everyone was doing that. And I was working at FICO at the time, and we actually had to redo our scoring model a little faster than we wanted to, because what we found was people's FICO scores were going up because people were paying off their credit card debt. But it actually was sort of a temporary bounce that wasn't reflective of an actual change in their behavior, because a lot of them were just then piling more debt back onto their credit cards, right? And so even though I think, the personal lenders were very genuine in their desire to we want to help people get out of credit card debt, we think this makes sense. I know a lot of the folks in that space, they were trying to get consumers to do A, and yet while some people did, other consumers kind of went down door B. I'm curious how you think about that, because obviously I think you and I have probably gone back and forth on Twitter about this. I think 0% interest, buy now, pay later is just structurally safer, better, lower cost than revolving credit card debt, right? Revolving credit card debt is a bad way to borrow, right? It's a bad way to live.
It's actually, I would argue it's the great way to borrow. It's a crappy way to repay, to put a finer point on it.
Yes.
It's so easy.
Yes. No,
it's
that's
too
right.
easy, and the structure is designed to reward the lender and kind of screw the borrower.
Right. And I agree with that. I think that's absolutely right. And so to an extent, and I've heard you talk about this publicly, right? We want to really disrupt the revolving credit card debt space. That is a goal we are aimed directly at. And I think that happens, right? Particularly for younger consumers who maybe have never gotten used to credit cards. And so they're oh, hey, I can just do this instead. And especially if it's attached to a debit card. Wow. But you also do see consumers who use a credit card, revolve a balance, and take out buy now, pay later loans, right? And those things can also overlap with each other. So I guess you referenced libertarianism before. You don't want to be too paternalistic and trying to tell customers you can do this, you shall do this, you shall not do that. But how do you think about striking that balance and maybe trying to nudge consumers towards one thing versus another thing?
I think the practical reality on the ground kind of speaks for itself, maybe better than the philosophy. I agree with you. The worry about stacking, to use industry slang, is very real, and you could probably even start from there's not just one BNPL, so you suddenly have access to all these BNPLs, and your credit card's still there. So I think there are a couple of things that you can do, that we do as a firm, all of them. And I certainly am very, very vocal about the industry, what should be doing this as well. So first of all, practically speaking, typical American household, if they're revolving, it's about $10,000 of revolving debt. So that's kind of, I think, the average, and it has been the average for quite a little while. Typical outstanding balance to a firm in that cohort is $700. So just to give you a sense for
a scale.
It's scale, but it's also, if you look at the annual spend, we are encroaching on, a typical borrower in that world also spends in the order of $10,000 to $12,000. They are spending on the order of $3,000 to $4,000 with us. And so I'm a little bit apples to oranging it, because I'm quoting data from our card, which is a little bit more frequent. So you can apply discounts a little bit, but practically you borrow 10 grand a year and you revolve in 10 grand a year. You borrow $3,000 from a firm, you don't revolve, and at any given moment, you owe us $700. That's a pretty good trade. Like you are paying it down faster than you're spending it. Like, and again, like there's a little bit of a hand waving here going on in terms of like the cohorts I'm comparing are slightly different, but they're not that different. And so that's a really good sign. And so first of all, it's practically true that whether they're using credit cards or not, and of course I'd rather they didn't revolve, they are moving some of that spend into a device that's better. A 0% version of it is like most certainly better, because then like you can potentially go in perpetuity and you're just getting paid to borrow money, which unfortunately not our business model, but it's, you know, it's good when retailers or manufacturers want to make it that much easier for you to say yes to a thing by just essentially subsidizing your interest. So that's just like, that's factual, like what's going on in our world. So how do we do it? One, going back to the very beginning, no late fees makes you really, really care about underwriting. Like if you were writing checks left and right to see what happens because you have, you know, the crutch of just paving over it carefully with some late fees and compounding interest, sure, like then you're not that far from being another credit card provider. If you're holding yourself to a standard of, if you're not going to pay me on time, I'm going to lose money, you have two things. One, you want to be good at underwriting, but two, you also want to be mindful of other borrowing. You can't just say, hey, you're borrowing $1,000 from me. You've always been good. Here it is again. No late fees. You have to be mindful of, well, but what else have you done lately? Like if you take out a giant loan from Prosper and it looks great, but your credit card's back to fully utilized and you've added this big pile of debt, no, you're not actually good for another $1,000. You may be lying to yourself and you think it's cool, but it is not. And the answer is going to be, you're going to have to save up for a down payment, or possibly the answer is no, because like you are overextended. And you know, as often as we say no, as compassionate and polite as we try to be, we're pretty firm on it because we have no way of benefiting if you borrow and can't pay us back. So that's sort of part one.
Right.
Part two, and this is the part where I sort of yell about this with the industry quite a lot. It is high time that buy now, pay later is reported to the credit bureaus.
Oh man, you are on the right podcast to yell about this. So please go ahead.
You know, I think I've called for following Credit Reporting Act on maybe 3 podcasts in the last as many weeks or so. So this isn't even the first one. It's just, and so there are 2 reasons for it. Like, and it's like a most basic logical analysis. So part one, if you are opposing reporting, so either it's because majority of your consumers are telling you, do not report us to the credit reporting agencies because we don't want anyone to know we're borrowing money. Is that because you are encouraging them to borrow and be not exactly on time? And the price is like, I won't tell on you, but you'll pay me money. Like that is like,
well, that's a value prop that's like built into the marketing on some of these places, right? Where they're like bullet points. And you always think about like 5 bullet points on a website of like why you should use our product. And bullet point number 3 is we don't tell on you to the credit bureaus. And it's like, ooh, gosh,
and so
that's
that appeals to like a very specific group of people who are like, actually, like I'm definitely going to be late. Yeah. I totally don't care. I'm sloppy. And I just don't want to ding in my credit score because I care about the credit score, but I can't be bothered to be on time. So it's like, great, let's teach you to be irresponsible and let's teach you that you can use money to pave over your irresponsibility. Like maybe for a change, the better play is to say, hey, you really need to grow up and be an adult. And when you treat us like responsible adults, we will treat you like a responsible adult, which by the way means building a credit history and improving your credit score. So if you are on time, which 95 plus 97%, whatever it is, of our consumers are never late. Their anger at us many, many years ago, we started reporting over 10 years ago, was like, hey, I have been on time every time. Why isn't my credit score going up? Like I bought into your Kool-Aid. You said, drop the credit card, use Affirm. I did. I've always been on time. It's amazing. Like love the service. Why is my FICO score not improving? Or a Vantage score? What?
Well, and the reality is like, hey, happy Affirm customer, but I need to buy a car in the future. Do you do auto loans? Do you do mortgages? I need other things.
We live in the world where your credit score matters for a lot of things. Like renting an apartment is a credit score extraction event. Looking at a college loan is a credit score related thing. So there are all these things like for right and wrong, we live in the world of credit reporting being very, very important. And your credit history is even more important than your credit score. Credit score is always like, it's behind. They didn't compute it frequently enough, blah, blah, blah. Credit history is the lingua franca of here's what you look like as a responsible adult. And so a vast majority of your users are absolutely interested in having a reflection of their responsibility in their credit report. It is your responsibility as a lender to say, here's exactly what happened. This person was on time or they were not, but then they cured. Like those nuances are really important. When your car lender looks at it, it's a difference between paying like an extra $100 a month sometimes. And like it's not our business, but it's our responsibility. And so that's why we are super pro reporting. That's why we were the first ones to report. We report to, we don't report to all three right now. We report to two. We'll report to all three. We worked with FICO for years to help them adjust their scores. The initial cut from the bureaus was like, hey, we're happy to do it, but the FICO is probably not going to utilize it. And then, and
FICO has a BNPL version of its score
which
coming
we
out
co-built with them or co-designed with them. So like we were in the middle of this stuff for years because we care. And I think a easy way of telling the industry, here's why, or not the people who care about such things, if the question is like, why aren't you just like a form of incremental credit that doesn't help the world? You're just encouraging over borrowing. Like, well, you have 3 credit cards in your pocket. Most people have 5. Maybe I have 18 because I'm an industry. No, I don't actually have 18. But like,
I have a few,
all of us. I used to have a stack of debit cards I got from everyone. Like it's just,
I have a sock drawer that's full of old cards.
Gotta try to buy.
And
so like that in of itself is okay. You know that your aggregate borrowing goes on a quasi-public record. You will behave more responsibly than if you don't, which is why I think it's so important that the industry does it. I think we have led the way for quite some time. The time has come for others to follow us, and I'll continue screaming until people start following our lead.
Well, I appreciate it. I will scream into the void with you. I sometimes feel like when I'm writing about this in the newsletter, I'm like, I kind of feel like everyone else is like, would you shut up about this? I'm like, no, I'm not going to let it go. I'm going to keep talking about this because I think it's a good point just about, and just to put a fine point on it, like we can have a closed loop ecosystem or we can have an open loop ecosystem, right? And like closed loop tends to be better for the unit economics of whoever's operating that network. But if you don't allow things to be open, and this could be open banking or furnishing data to the credit bureaus or whatever, like it prevents the customer from being able to exercise a level of control and choice. And so I think that's the thing I get mad about is like, this might be good business, but it's bad for the customer.
Yeah, I think it rhymes with this whole, like, I'm a libertarian in spirit, at least, if not in action all the time. I don't want to be paternalistic. We've used to have these debates so back to sort of like, how did we set the DNA of the culture of the company? Like, how do you know what's right and what's wrong? You debate. And back in the day, we had these debates that we settled maybe in somewhat unpredictable ways where, like, should we be lending money for things that are luxury? Like, because they're not essential, why would you borrow if you should save? Like, one man's luxury is another man's necessity, and it's hard to tell. And like, maybe you could interview the person and be like, do you really need this really fancy bicycle? Like in my case, yes. Like I don't replace my car unless it's stolen, but I love my bikes and I'm going to have just the right bicycle for the season and so on. And then for someone else, like bikes are total luxury, but they need the, nylon rope to climb, or that was the original debate at the very, very early days of Affirm. There was this PM who was like raging against luxury borrowing and also bought this really, really expensive rope. And we're like, all right, I think some people might find your obsession with perfect rope for climbing a bit of a luxury decision. And he's like, and from that came our policy, like, we will not judge what it is you're using Affirm for. If it's legal and we can underwrite it, we will. We also expect you to pay it on time, even if it were a totally luxury decision. And so within that sort of like, how do you settle these things? We have long settled on this notion that on the one hand, sure, it'd be wonderful to keep all this data for ourselves and continue our underwriting advantage because more data is better underwriting advantage. But in practice, what's good for the consumer is their history is public enough so that they can get a good deal in a car and a mortgage. And like, that is more important than hanging on to our precious data. And so that's what we're going to do. And I think so should others.
I totally agree. And I think that, it brings me to the last thing I wanted to ask about before I let you go, which is this sort of like, again, customer choice, helping customers make the best possible choices. you can't really talk about that in 2025, almost 2026, without talking about agentic commerce and agentic AI, a topic that I know you're spending a lot of time on, and you guys have talked about publicly. And I'm sure for as much as you talk about publicly, you're talking about it 1,000x more internally that hasn't quite come outside yet. But I guess to start with, like very, very simply, when you think about agentic commerce, because it's such a popular term, Max, that I can't keep track of what it means when I read press releases from different companies about it anymore. But like in very simple terms, like what's your framework for agentic commerce? And then I'd love to kind of understand like how you think it will impact consumers, merchants, like how it shakes up this Amex type network.
First of all, I think the definition is being written even as we speak. So it's dangerous to declare, here's the framework. So first of all, you need to be open-minded. It's a little bit like you haven't asked, which I'm grateful for because, boy, that's another rabbit hole. But stablecoins and crypto in financial services.
That's the next podcast we're going to do, Max. I'll have you back for that one because that's a whole
budget 7 or so hours and we can go. Yeah,
right.
But since we're not there in 20 minutes or fewer, so. Like, one of my favorite phrases, the future is already here, is just not evenly distributed. And agentic commerce is already here. Yeah. It's not evenly distributed. So last night I got home after a long day of, podcast recording and doing product reviews. And
I'm sorry, Max.
This was yesterday, not today. But yesterday I got home and I had this really a vision of cooking my own dinner and serving it to my family. And sure enough, I agentic commerced myself some DoorDash. That is agentic commerce. It's here now. And I don't know the name of the person who shopped for the Chinese takeout that I ended up having, nor do I know the name of the person who delivered it. I just know that my app flashed up and said, your food's at the door. Pick it up because it's going to get cold. And there was a swarm of agents. There were multiple agents involved. Like, not only that, they had my payment information. Like, I didn't click on any, here's my CVV2 number. Like, poof, I wanted fried rice, and there it was. And so that's agentic commerce, and that's like the baseline is here. And I don't know if that's going to change in a way that we can perceive. It'll just change in a way that is going to make it cheaper. Like, there will be embodied AI sorting through. And by the way, when I do cook, or when my wife and I cook something together, almost certainly the ingredients are going to be brought in here versus us running out to the grocery store because what if it doesn't have everything we need, et cetera. And so it's super convenient and it is agentic. And so I think those apps remain relevant and they will continue to be relevant. On the other side of it, there are things that I don't think anytime soon will flip to a different user interface. But user interface is the best way of reasoning about it. It's like, I'll explain why in a second, but the UX part is like, that is the important piece. And so,
you mentioned modalities before earlier in the podcast.
That's the fancy term for UX, I think, here. And so if you are using shopping as entertainment, which a lot of us do, you don't want to lose that. Like, the fun part of my Instagram ad consumption is I get to see the coolest new widgets in cycling and coffee and like the 5 other things that I'm into when I'm not building a farm. And like, no, I don't want a robot to decide that I need a new high efficiency shower screen for my espresso machine. Like, I kind of want to read about it and I want to see the video, and I'm like, it's beautifully shot. It's there for my entertainment. And then, like at the end of this, I'm going to spend $25 getting a small piece of metal that I'm going to lovingly install into my machine. But that's a whole journey. Like, a lot of value is acquired in the beginning when I realized that, like, it's the thing that I've missed my entire life without knowing. And so that part's not changing anytime soon. And it will appear like one of the things that I think people are kind of, the engineers behind these products and maybe even people like me are cringing at, but it is absolutely coming. Your chatbot will have ads in it. And those ads are going to be really, really good. Because it's going to be like, hey, we're not just like randomly discovering that you're into coffee, Max. You're into coffee and bikes. So here's a great travel destination in some cool country you've never been to, where there's just one coffee shop that all the cyclists go to, and you'll run into your favorite pro there. Like, I can see that ad coming, and like, no Instagram ad is going to be that good. And yet, like, the ChatGPT or Gemini one or whatever comes next will be, because it knows that I'm into travel and into bikes and into coffee, and I'm kind of a chamois sniffer pro cycling lover. And so all these things combined, like, because I talk to ChatGPT about it all the time. And so anyway, so I think that's coming, and it's super fun. And it's a little bit more like a glossy magazine that writes itself for you in real time. And like a part of the thing, like the ads will come alive and will talk to you and know your name and know your preferences. And that's more of an advertising thing. And like the part where you click and the shower screen for your espresso machine arrives in a box, like the fact that you clicked on buy versus it just knew to click on buy for you is like almost like a preference. It's like, do you give DoorDash your card number, or does it just know, or do you just use Apple Pay or something? And so those are the two things that are like, they're both here and they're going to get better, and they're not that interesting. The most interesting part to me is actually where Affirm lives. And that is where you are thinking about the item. You've made a buying decision, or at least a buying sketch in your head, and you want to talk about the thing you're buying with an expert. And the expert in this case is AI, because it is already smarter and only getting smarter about the world. And so when I want to buy a bike part that I'm not qualified to personally service or change, like a drivetrain replacement, like that's a big surgery on a road bike to replace, and somebody's listening be like, I replace my own drivetrains all the time. Like I can do it too, by the way, but it's really friggin' hard to get right. Yeah.
It's hard.
So I'm probably going to go to a local bike shop to get it replaced, but I do want to shop for it online, and I want to talk to someone who can tell me all about the power characteristics and the weight trade-off and the new systems that's come out, and do I want this or that sort of a chain lubrication. And that's a conversation. It's a considered purchase. That's when it matters. And within that world, you're going to have real AI thought partner. And it's going to extend across the entirety of your interactions that are commercial and non-commercial. But the commercial ones are going to be, first of all, it's going to be very tricky to navigate what's almost certainly going to come first, an advertising business model for the chatbots and the various sort of incarnations of that idea, and the need to be completely objective. Like, of course, the conversation about my drivetrain replacement plan is going to involve 3 main brands of drivetrains for road bikes. Which one of them is going to want to pay for my attention? And like, you got to need to be, but then again, Google solved this problem. They have the little tag that says ad, even though you're searching for something that you expect to be honest. So anyway, we've solved a lot of these problems before. In that domain, I think you are not going to see just buy it for me. In the sort of agentic commerce a la DoorDash, you will absolutely see, we've decided you're tired and you need food, and your favorite is Chinese vegetarian, and it's on its way, and you have 5 minutes to say no thanks. Or so, like we will start flipping defaults to, it's just going to happen, and like it, and there'll be some absorption into like, so who bears the responsibility when you said no in 5.5 minutes instead of 5? So like, the harder problem here is if you use it with Affirm and you have authorized your agent to look at a truth in lending disclosure, but then you have a second thought and you're like, I didn't see it. Attila here, so I'm going to say no to this. Who has the power of attorney here? Like, is the agent you, or the agent you, but not when it comes to some legal agreements? And so I think I'm not afraid of any of those puzzles, because they're a lot of fun, and we will sort them out in reasonably short time, because we have sorted them out all the previous modalities of past payments. The part where you're talking to your agent about, I have in mind a TV or a drivetrain replacement, a thing that I'm not an expert in, and there's not that many choices, but the choices are significantly different. Like, I can have a TV that has a better black and white balance, or a better sound system for the best price. How do I compare the two? Like an agent or agentic conversation, and by the way, agents talking to each other about my preferences and the size of my living room and the sound system I already have. Like, that is a great time saver, and maybe not as important as like I'm entertained by this purchase. Like, I just kind of want a better TV. And so like, I think that's like
totally. You're like looking for an outcome.
Yes. So the outcome driven, that's actually a really good word. Low skew, high featureization, heterogeneous transactions. Like, that is the sweetest spot for like that. That's where AI is going to punch well above the human weight, like very, very, very quickly. Already is. That makes a lot of sense. So, I mean, like a slightly different turn of that, but I was having an experience where I talked about this on the podcast already, but like I had wasps living in my wall, and that was unfun. And my wife decided that was going to be my problem to solve. So, I got the privilege of a good problem to solve, something to practice and to work on. And it was interesting actually, because AI was very helpful
in almost constructing like a workflow for solving a problem, right? So it's like, take a picture of the hole. Oh, there's a wasp. This is probably what's happening. Do these 3 steps. And interspersed in this workflow that it was building dynamically were moments of commerce, right? Like, here's the type of spray that you want to get from the store based on this hole. This is the thing you have. But there was like a responsiveness to the problem solving workflow that it was building dynamically that created like, I don't know how much money I spent solving my wasp problem in my wall, but it wasn't insignificant. And like every step along the way was a contextually driven sort of considered purchase in the context of this problem it was helping me solve. And it just struck me when I was doing that, like, that's not something that I would have been able to replicate without ChatGPT.
Yeah, and
you know?
So to sort of finish the thought, maybe, I think that particular type of transaction is going to be very important for us, but it's also, a firm will be very important for that particular type of transaction, because just as AI is going to be your best wasp nest elimination expert, it is not going to sleep on things like deferred interest or excessive late fees or whatever other things make financial decisions dumb. So it's going to be smart, and it's going to ask the question as you buy your wasp, anti-wasp weapon, whatever it is. I'm imagining like an anti-wasp bazooka, but it was probably more like a spray of some sort.
That's what I wanted. It was a little more mundane than that, but that's what I was hoping for.
If I fought wasps, I'd look for a bazooka myself. Fortunately, I live in a place where it's more of a mosquito land. I did have to consult ChatGPT in my search for like the best mosquito elimination device, which I purchased, and it's very effective.
That's what I'm saying.
It's amazing.
Yeah, that's what I'm saying. It works well.
And so I want my ChatGPT to automatically say, by the way, if I buy this thing and it's kind of expensive, I want the best possible financial deal. And it should find, hey, this one is a 0%. It's offered by a merchant with a great reputation. Using a firm, of course, there'll be no late fees. And when you pay it on time, because I will make sure you pay it on time as your ChatGPT or AI-powered financial advisor, it will go on your permanent record in the best way possible, and your vulnerable credit score will, in fact, go up. So this is the right financial decision for you. And so I'm quite excited about that future, because I think a lot of the, probably should pay on time, but I'm late. It sucks. It's good that I picked a firm. There are no late fees. Like, that's fine. Like, we built a business around that. But a better version is my AI robot told me that I should use a firm because it's the cleanest, best, smartest financial decision for me. And by the way, I'm going to make sure that the AI and I, behave like responsible adults vis-a-vis a firm, because they were responsible adults to me. So I'm looking forward to that future.
No, I mean, and just, to put a capper on this, to me, that's the thing that I think is really interesting, right? Is that, like, going back to our earlier conversation, why are we doing this? Why are we putting the TILA box here? Why are we, committing to 0% interest in these cases, and then no late fees in these other cases? Like, why are we holding ourselves to this standard that other people in the industry don't hold ourselves to, and that, quite frankly, we could probably get away with, because, consumers don't always shop in the best way. They're not always optimal in the way they do these things. I mean, in a strange way, and correct me if I'm getting this wrong, like, you guys have kind of been waiting for agents to scrub a lot of the like inertia and bad decision making out of this stuff.
Well, one of my favorite metrics to quote is when we launched a firm, we were the only ones charging no late fees, and the industry mocked us. And like, I can name names, but I will choose not to. Like, people in the industry who like privately and publicly said, like, you're an idiot. Like, you're not only are leaving money on the table, you will never be profitable. Like, this is just not how this is meant to work. And obviously, we're living proof that yes, you can be profitable. Yes, you can build a big business on this, like, just do the right thing and they will come approach that we've taken, and the high standard that we hold ourselves up to. It is now, I think, last I looked, it was true, and I think it's still true, more than half the volume of BNPL in the US and Canada is late fee free. So we're not the only ones. People have followed us, including people who have made money in the past, not just like profit from late fees or deferred interest, which is like a late fee exponentially. And so we have pushed the rock up the hill just enough to make it uncomfortable for those who, none of these people are evil. They're just sometimes indifferent. And like our high moral ground, sort of you hold yourself to the highest bar possible approach, has pushed the industry towards being better. When I think that's probably the most important thing we've done. The reason I'm so excited about these AI, sort of everybody's smart, no one's going to get screwed, is because it's going to be a much easier time pushing that rock up the hill. Like before you know it, the majority or maybe the totality of the industry will be like, well, it's kind of dumb to charge late fees because people don't pay them anyway because their AI agents prevent them from doing so. So now we don't even have the marketing tagline of no late fees here. It's just these Affirm guys that get to say it and those who join them. So I think we are about to see a big shift in the industry towards this like more moral behavior because the I bet you won't notice play will not work anymore. Like, that is pretty great.
It really is. And I think that is an awesome place to leave it. Max, thank you so much for being generous with your time. This was an awesome conversation. And we will do the stablecoin crypto one. I promise. We'll find a time when we have 8 hours to spare and can really get into the weeds.
Sounds good.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.